In this video, I'm going to talk about the remaining 5 accounting principles, which are as follows. So let's get started with the conservatism concept or principle of conservatism. So the principle states that we have to be, conservative in reporting the profits, in reporting the gains in the business. What this really means is that if there were, let's say, two types of accounting treatments that you could do, accounting treatment 1 and 2. Now, one results in, let's say, a profit of 100 and the other one results in a profit of 90. Which one should you choose? The principle dictates that you should be conservative. You should report the one which shows lesser profit. In other words, the principle dictates that we should not try to, overstate the profits which are not certain. Now, these are likelihoods, these are possibilities that you will recover this money or not. And, you should adjust for that uncertainty, and you should show only the amount which is certain. Another variation of this, another use case of this principle is to show the provisions, to create the provisions for uncertainties. What this means is there are possible losses, and when we were going through the balance sheet of Reliance Industries Limited, we looked at an item called provisions, and I said let's postpone it for future. Now let me explain that the provision for uncertainties, this can include provision for taxes, it can include provision for bad debts, it can include provision for any dividends that you might have to give in the future. Right? What does this mean? This means that a provision has to be created out of profit. During the year, you make some profit, you keep some profit out as a reserve, as a provision, because in future there may be a liability which you will need to pay for, and at that point in time you may not have immediate money funds available. So right now keep saving for the rainy day is what this principle says. Provision for taxes, taxes are a certain regular expense. However, how much tax to be paid is something which is very variable. Rules and regulations change, your business changes, geographies changes, type of taxes they change. So due to all of that, you create a provision and you try to have that amount in this specific reserve, in this provision, so that even if the amount of taxes is higher than what we anticipate, we have money on the side to take care of it. Similarly, you have provision for bad debts, which means it is possible that some of the customers may not pay back for the goods that they have bought from the company. So in that case, what do? So you have to create a reserve so that whenever such a loss happens, you can recuperate the loss from this reserve, from this provision that you have created on an ongoing basis. Similarly, dividends are paid. The companies which are mature in their lifetime, many years of existence, these companies pay regular dividends, and they have to create provisions for dividends, because dividends can also be increased or reduced as well. So these are some examples of provisions. So I discussed about two different things in the conservatism concept. The first one was you should always prefer an accounting treatment which understates the profits, understates the gains of the business, and you should always prepare to state the possible losses that you may face and also prepare for those losses. Now let me quickly show you an exhibit. This is from page 277 of the annual report of Reliance Industries Limited, and there is an item called provisions. What does it say? Provisions are recognized when a company has a present obligation. It can be a legal obligation or it can be some other kind of obligation, as a result of a past event. It is probable that an outflow of resource embodying an economic benefit will be required to settle the obligation, and reliable estimate can be made of the amount of the obligation, right? So you see that there is some certainty, reliable estimates can be made. There is uncertainty. It is probable that this liability may arise in future. So you have to recognize, you have to create such provisions in the books of accounts. So this is a proof of this principle of conservatism. Next is the principle of accrual, or also called accrual concept. Now there are incomes and expenses of different stages. There could be incomes which have been received, and there could be incomes which are to be received. All right, and same for expenses as well. Okay, what does this mean? You create financial records for an accounting period, and accounting period is a financial year. So let's say financial year 2020-21, it starts on April 2020, it ends on March 2021. Okay, you sold goods, and 100 is the value of the total sales. However, you received cash for only 50% of it, and the 50% of the sale is on credit. What does this mean? This means that you have received this, and this is to be received. So we're talking about cash being received for these or not. All right. So same for expenses. Expenses, let's say in order to sell these goods, you had expenses of 80, and you paid for say half of the expenses, and the rest of the expenses are to be paid. So this is paid, and this is to be paid. Similarly, I should have here said paid and to be paid. All right. So this is one section where I wanted to clarify the expenses and incomes can be in two different stages, paid and not paid. Now let me club this understanding with the concept of when you earn these revenues. Okay, now the sales, the revenue that you have made during the year, you have transferred the ownership of the goods, you have shipped the goods to the customer, they have received the goods that you sold to them, and they're supposed to pay you. Half of them already paid you, but half of them have not paid you. Now, the other concept that I want to club this with is the concept of earnings. When have you earned? When have you earned these versus when have you received this income? You have earned 100 rupees. You have earned 100 rupees during the year because you have transferred the ownership, the possession of the goods to the customer. So, earned versus received. Right? So, earned means when you deliver the goods or services, and received means when cash or you in the bank is received by you. Okay, now which one should you consider in the books of the accounts? Which one, you're supposed to report the financial results for the accounting period, for quarters as well. What amount should you report? Should you report the received amount, or should you report the earned amount? So this is where this principle comes in. This principle, the accrual principle, says that you have earned 100. You have earned 100 rupees, which means the 100 rupees have accrued to you. It's an accrued income. Accrued means it has become due to be paid to you. You have the right, you have the legal right on this income. If the customer does not pay you, then you can go to the court of law and sue the customer, and then he will have to pay it, or the legal processes will ensure that you get your money. That is what the concept of accrued income. I'm repeating it. Accrued income means you have earned the right to receive, and you earn the right when you deliver the goods or services to your customer. Alright, this is accrued. So in the books of accounts, when you are showing results, financial results for a period of time, you should show total 100 rupees as your income and not only 50, which means that accounting, this leads us to the conclusion that accounting records are prepared. So accounting is done on accrual basis, meaning that is it should become due. Does not matter whether it has been paid or not. So accounting is done on accrual basis. Similarly, if you look at expenses, you have not paid 40. Only 40 has been paid by you. However, for the given financial year, you will say my total expenses in the financial year are 80. I have not paid it, but accounting is done on accrual basis, credit basis, due basis. So if I have received the services of my employees for in this year, then I will have to pay them. Even if I pay next year, I will be paying them for this year. That is the principle of accrual, which is on which the accounting is so heavily based. As we move along in the process and learn the process of recording, classifying, and summarizing the business transactions, you will see that we make use of this concept a lot. This principle is going to be used very heavily. Let me show you now an exhibit. Now this is page number 278 in the annual report of Reliance Industries Limited, and there is an item called revenue recognition. Revenue from contracts with customers is recognized or recorded when the control of goods or services are transferred to the customer. They say control, that means it has been delivered, and if after that they lose the goods, then we are not responsible, at an amount that reflects the consideration. So, there are rest of the details, but all I'm trying to say is look at the annual reports. They tell you that we are using these principles. Everybody has to, all the companies have to disclose, they have to, they have to say mention in their annual reports that yes, we are following the accounting principles to the full, and this is the detail of how we were doing it. Okay, let's move on to the next principle. The next principle is called matching concept, or the principle of matching. So the clear question is, what are we matching and why are we matching that? We match the incomes to expenses. We match incomes to the expenses. Why do we do that? In order to figure out if we made a profit or a loss. How do we match it? We compare these two. We say income minus expenses equal to profits. That's what is meant by matching. This is my expenses, this is my income, I'm matching it. This is my graph for income, this is my graph for expenses. The remaining, this is my profit here. Right? That's what, matching indicates in this principle. All right, well, this is very generic, but there must be some more essence to it, which is as follows. Now, when do we do it? When do we do it? We do it every accounting period, which would mean you have a financial year, or you can have a quarter 1, quarter 2, quarter 3, quarter 4. Quarter 4 is actually end of year. So you directly go to financial year ending. So every period which is significant for the company, or when they are required to do, you match your incomes to your expenses to figure out the outcome of the business. All right, that's number one. Second is how. How do we match it? You match it according to a format. format given for profit and loss statement. And I showed to you, and I will show you now as well. For Reliance Industries Limited, you have a format. You have incomes at the top, and within incomes, you show your operating incomes, you show your non-operating incomes, you show if you've collected any taxes, and so on. So, a format has been prescribed for the companies to follow that. Okay, and then what else, within a financial year, according to a given format, what else is there is the incomes and expenses are going to be matched according to the accrual principle. Accrual principle. Now, what does it mean? According to accrual principle, we have to recognize the revenue, or we have to record the expenses when they become due, right? Accrual basis. Therefore, we include for a given financial year, while matching the incomes and expenses, we include all incomes and expenses that become due in the given accounting period. So accounting period can be a quarter or a financial year. So the point is, the period for which you are preparing the financial statements, if during that period an expense or a revenue has become due, then you should show that in this matching in the income statement to figure out the profit and loss. Again, this principle is building up upon the principle accrual principle, but what it really is, also it is bringing in the principle of accounting period. So what it is necessarily doing is clarifying to us that the profit for a period, profit for financial year 2021 is equal to revenues due in financial year 2021 minus the expenses due in financial year 2021. All right. So you may have received it may have become due, and you may have received these revenues. The expenses may have become, and you may have paid it as well. But even if you have not paid it, you include it. Even if you have not received the revenues, you record them. And that is how you figure out profit for a given period. That is the matching principle. You match revenues earned in a given period. So revenue earned in a given period and expenses incurred. So earned is equal to incurred in terms of for expenses. Incurred means they have become due. So instead of cash basis, you go on accrual basis and you match your expenses and incomes to find out the profit. That is what matching principle is. Let's now look at an exhibit to prove this point. You have income and you have expenses. You're matching them to find your profit. Now this value of sale, although they are not required to report how much was credit sales, but you could easily go to the balance sheet and look at what are the debtors amount, that is kind of credit sale. So this sale would include the debtors as well. So customers to whom goods have been sold on credit, the money which is to be received from those people is included in this amount, right? Similarly, cost of material consumed. It does not say that you have paid for these materials. It is possible that you have to pay for this and you'll pay for maybe 50% of this will be paid in the next year. Does not matter. You have received the material, they are with you. Now it's your responsibility to maintain it, and your supplier will recover the money from you if you don't pay. Legally, he has the right. So this amount will include the price of all the material which you have received. So you compare these two, in a given financial year. The financial year here is 18-19 and this is 17-18. Now year on year you could compare that. You can match your incomes and expenses and find out your profit. All right, let's go to another principle, and this is going to be quick. Full disclosure principle. This simply means do not hide information. Do not hide any material information. Now, a public company is owned by public. There are, lot of disclosure. There are actually accounting. These are accounting standards, which are, further minute versions of accounting principles. These are like, I give an example of, say, boxing match earlier. In a boxing match, you decide, what is going to be the venue. You decide that 3 months in advance, who are the opponents, and what will be the rules, of engagement and so on. That's decided way in advance. And then when the boxing match actually happens, then what are the technicalities involved? How do you count the score? And how will a winner be decided? When the opponents will have to stop the match, there will be a referee. There are minute details which you have to follow. So similarly, generally accepted accounting principles are more of broad understandings and common knowledge and guidelines which you have to follow. The accounting standards further give you specific details of treatments of some of the items. So, in this principle of full disclosure, what we're really talking about is that the company has to disclose all important, significant information. Second, they have to follow the accounting standards which have been given, and they have to disclose information as per that. Also, the generally accepted accounting principle and any other act, sub act under the Companies Act 2013, they have to follow that and disclose that as well. I'll quickly show you exhibits to further prove how full disclosure is adopted by these companies. So this is page 274 in the annual report of RIL. It says significant accounting policies. I'm only showing one accounting policy, but in any annual report, you would see that the company has given the details of accounting policies that they have used in preparing their financial statements. So it says financial statements have been prepared on historic cost basis, and this is the cost principle that we learned earlier, except for following. Now, there are some exceptions you are making, there are certain things you are actually following as they are. So you have to disclose as a company, put all that information in the annual reports. This is concept of full disclosure for you. Another example of this is in the property, plant and equipment. This is balance sheet, note number 1, assets, breakdown of assets, fixed assets. So you have gross block, depreciation, and you will see, within these tables, and I've not spoken about these earlier, the balance at the beginning of the year. Then there were some adjustments during the year, which could be, you purchase some more of land here, you sell some of the land here. So all of that detail has been provided by this company. Then further to this, now if you look at this leasehold land, that's not all the information we have about leasehold land. You can look through the annual report and find out more. So if you go to page 285, the next page, you will see for leasehold land, for building, they are giving further more information. They're talking about some more detail have been provided about these assets as well. And if you look through other section of the report, you will further find what new assets they purchased, what were the locations, and so on. So another exhibit to show you that companies have to go in great depth to disclose their details of their assets, liabilities, incomes, and expenses. All right, we come to the last accounting principle for this video, which is materiality concept. What does this mean? This means, there are terms which have been defined. Let's say assets. Think of smaller items in stationery. Now, smaller items in stationery, like you will have books, you can have a stapler, and so on. A number of small things that you purchase. should you regard these things as assets or expenses? Going by the definition, books, staplers, these things, they stay with you for more than 1 year. The life is more than that. However, the value is, very small, and the importance that these things will have in the, running of the business, functioning of the business, or on the outcomes of the business is, very low. It's not very material item. Therefore, the concept says please do not create a record for every small thing, every pencil, every pen, every eraser that you purchase for the business. Do not create separate records for that. Create generic headings, create stationery, and then club hundreds of small, small items under that, so that it is useful, it is easy for the stakeholders to look at the final reports, financial reports, and understand that, and also pay more attention to the material facts, more significant numbers, rather than getting into very, very small details which may not have, which may not be of great consequence. That is the materiality concept, or the principle of materiality for you. So there you go. We discussed about 10 accounting principles, and there are, as I said, a few more here and there, but I largely cover those in these 10 accounting principles. These are the ground rules which we are going to be following, and I've already showed you the statements of Reliance Industries Limited, also shown you proofs of how these principles are being followed. So I'll see you in the next video.